Welcome to the B.F. Anderson Technical Report for December the 1st. You know, demographics are a very important long-term factor that we need to understand because I would say there's three things that you should focus on. One would be demographics, two would be corporate earnings, and three would be interest rates. Focusing on those three macroeconomic issues probably would save you a lot of time of thinking about other things. Now, this is a population distribution in the United States. Now, you can see here the millennials have now passed up the baby boomers as far as size of the population. So we've got a young population. Now, this is real important because if you look at Japan, for example, Japan has an aging population. As a result, if you think about it, you know, young people consume more than old people. And what we're going to talk about here is that pattern. Now, just to make the point also, there's really one other country in the world that has favorable demographics. It's the United States and India. So you can see India has a young population as well. So this means, basically what it means is consumption. So if you have consumption, and that means corporations have revenues, which means corporate earnings. Now, this is an interesting graph. We've looked at this before, and it's just interesting to me, the correlation. If you take the period starting in 1981, 1982, which was the beginning of a great bull market, the average baby boomer, or the oldest baby boomer, turned age 35 in 1981. So the baby boomers started their consumption patterns, you know, things like Home Depot, Walmart, et cetera, McDonald's. And then when they turned 54 in 2000, it all peaked out. And we went into a really, real sideways bear market situation. Well, the good news here is that the oldest millennial turned 35 in 2016. So we are basically looking at a bull market that has the potential to go to 2035 when the millennials hit the age of 54 and we start seeing a peak in the consumption patterns. So demographics, they're important. Now, yesterday we had a really good move in the market. The Dow was up about 700 points. The NASDAQ was up over 4%. You can see here NASDAQ was really starting to get into trouble here. Still has not gotten above the 200-day, which we'll talk more about. Mid-caps above the 200-day broke out of this base here. I must say the mid-caps are looking pretty much the strongest. In fact, we're seeing a lot of stocks in the mid-cap category. New York Stock Exchange, again, above the 200-day, broke out above this base, looking very good. Here we have the small caps pretty much, staying within the base, however, above the 200-day moving average. S&P 500, actually yesterday for the first time, we've gotten above the 200-day moving average, which I think is very important. Now, just to look at it another way here, if we can break above the 200-day, which we're doing as of yesterday, and if we can hold up here, at least hold for about, I would say you need to hold at least 2 weeks. So we're in the first week of the break above the 200-day. Then you want to see that 200-day turn up. So that would really be confirmation that the market is put in a low. Volatility index, we're seeing much improvement in the volatility index. We're down to readings of 20.5. If you remember, the rule was under 21 or around 21 is where you want to be. That's the long-term average on the volatility index. So volatility is coming down, very positive. Now, here is the one problem we're having is this aggression index, which is a ratio of the NASDAQ compared to consumer staples. We got an uptick yesterday, but very, very small. Got very close to making a new low. We need to get above this lower moving average, and this lower moving average turn up. That would be a very powerful sign if that were to happen. Now, on our three economic indicators, now I think it's interesting that Jerome Powell, head of the Federal Reserve, came out yesterday and said maybe in December they're going to be able to back off a little bit on Fed funds rates. And it's really interesting to me how the market discounted this because we never really got above 4% in any meaningful way. We got up to 4.2, now we're down to 3.7, and interest rates, they're still above that 200-day moving average, but we're not seeing a big up move in interest rates. Also, with the price of oil, it continues to be in a downtrend. I know the oil stocks are hot and everybody, it's kind of a crowded trade in my opinion, but oil has been selling off. Financial stocks are doing much better along with the market above that 200-day moving average. On new lows, we're seeing some improvement there, not as good as we would like. We would like to see that 48 a day, new lows on the New York Stock Exchange right now, as of the other day, 68. We did have one day below 40, but that was very short-lived. But we would like to see a real consistent pattern there of below 40 a day. Now, on the bond market, here's the junk bond fund we've been keeping an eye on. Broke above the 200-day moving average, so the bond market is discounting, hopefully discounting interest rates that are going to stabilize here, and hopefully even the Fed might even consider cutting rates, but that's not in the cards at this moment. Now, I did want to point out MasterCard. This is one I've been keeping an eye on. If we were going into a deep recession or the market was discounting a deep recession, I don't think this stock would be breaking out this way. And also, it's very interest rate sensitive. And so basically, I do see improvement in things like MasterCard. Now, on the semiconductors, this is our tech group. Again, this has been a real problem area, but this is the SMH, which is an ETF of semiconductor stocks. You can see that we've kind of got what we would call a Darvis box here, and we're basically breaking out above the box, above the 200-day moving average. So if you get the semiconductors moving, that'll get the NASDAQ moving. Now, the yield curve, we're still seeing trouble there. I mean, we're down to a 0.73, indicates recession. This is one of the most inverted yield curves we've ever seen. Hopefully that's going to reverse. Now, on the top five, Wingstop. This is a stock we own. We own the stock. It's all a franchise. It's all franchise business. The numbers are pretty good. This is a pretty profitable little company. You got a gap up here on the earnings. The stock's been consolidating, and then yesterday we got a nice pop in buying volume, and basically moved up, broke out. This is what we would call a pocket pivot. On Prothena, which is biotechnology, somewhat of a breakout. Gap up, consolidation, breakout. We're seeing this pattern pretty much repeated throughout the market. Impinj, we call it PI, symbol PI. You got a big gap up here. We do own this stock. I have to disclose that. Made an all-time new high yesterday, looking in a very strong uptrend. They're involved in something called RAIN RFID, which is a RFID technology that is quite robust and much more powerful than the existing RFID. So it's somewhat of a disruptive technology, but it really seems to have potential. This is Catalyst Pharmaceuticals. This is a pharmaceutical. You can see here in an uptrend, kind of sloppy in here a little bit, but it's one to just keep an eye on. Enphase Energy, again, the solar stocks continue to look strong. We own a position in First Solar, which is in the business of making the panels. Enphase is in the business of making the inverters. But you can see here we got the gap up, somewhat failed, but kind of getting back into an uptrend again. I would keep an eye on Enphase. So all in all, things are looking much better. Hopefully the bear market is over. We'll have to see. But like I say, keep an eye on that 200-day moving average. We want to consolidate above that 200-day and hold it for at least 2 weeks. If you have any questions, please let me know.